Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon, all. Ira Epstein with your financial market update, and this is for Thursday, the 15th of March, 2018, just getting on to 3:55 p.m. Central Daylight Time. You're probably going to close a bit lower than what you're seeing right now. Remember, I don't know what the last 5 minutes of trade are going to be, and this is where the market's at right now. But we've been seeing a late-day rally all now in the past hour and a half or so of trade that has lifted the markets back up. And the question is, what next? And that's going to be the big issue. I did my best today in our live webinar, which is the first one I've held in a long time. I don't remember the last one I really did. And I tried to explain what's going on in trade, what's going on in the charts. And in a nutshell, Mexico's economic minister came out now, and I read this report just recently, and he said if nothing's done by April 30th, the reality of the situation is that the politics, both in Mexico where they're having the presidential election and the U.S. with midterms coming up, probably means nothing gets done until maybe the beginning of the year, maybe not even this year. That's interesting to see. We keep hearing talk that, no, the U.S. is bluffing on trade wars, and then other people saying, nah, don't buy into that at all. It's part of the, how do I say it, the negotiation process of making others understand that we don't want to push our allies away from us. We just want fair trade. Well, that's not an easy thing to do when you're trying to break decades of these tariffs being in place, and many of them probably don't belong there. And on the other hand, you've got China, which the U.S. thinks is dumping steel and aluminum on the world markets, and maybe that's what people should address. Who the heck knows? What I know is certain analysts are coming out bullish as can be these markets, even at these levels. Others are putting reputations on the line saying, no, this is it. This market's peaking. All the indicators doing blah, blah, blah. I can answer, I don't know. So what I'm looking at, and this is the March S&P, and I'm going to be switching gears very shortly now, remember, to the Junes on a lot of markets, caught between this trade high, this break low. That was the 12% break you had early on, the rally back over the 62% level, and now coming back down into what we call these Fibonacci numbers. From the top to the bottom, the traditional way of looking at it is a 38%, roughly a 50%, and a 62% retracements. So how far do you go? You can see you got over the 62, fell back to the bottom of the 38, came back up, and now you're challenging again back in here. In the process, you're probably making people have upset stomachs. They're trying to figure out what to do and how they do it. When I go to a weekly area chart of closes, I'm going to make this as simple as can be. You have an upside bias until the market closes under the 18-week moving average of closes. That's how I look at the longer-term chart right now. When I come to the daily bar chart, you can see these swings, and when you put the swing line on them, you have a very clear higher lows, higher highs. That is bullish, not bearish. When I look at the 18-day average of closes, which I think is what I call that line in the sand, I think it's a really important number on charts because I'll have an upside bias when the market's over it, a downside under it, and it filters the swing line. So it is saying that until you close under that number, the swing line is still saying the market is bullish. The problem I have is a realistic trader, not one that's in a school teaching theory without real money principles. If you buy the market against the 18-day average and you put a low under the most recent low, that's a heck of a risk. I mean, it's in real money, $2,500 on a futures contract. That's pretty big. In terms of Bollinger Bands, which are these black dashed lines, they're offering you what I'll call the theoretical resistance and support lines. Markets will trade within those bands 95% of the time. The 100-day average is far away. That's way down towards that band. But to get there, you're, again, probably going to scare the heck out of people. Let me tell you what could be bearish in theory. Take out today's high, reverse down, and close lower right through here. That could be the nasty part. You could end up then with lower highs, lower lows. That's what could happen. I don't know what tomorrow's going to hold. So right now, who's in control? Well, if you come here with your momentum, the momentum is down. In theory, at least mine at least, momentum leads price. That's pointing down. The bias is up because you're over the 18-day average, and the swing line's up. Really simple. It's not, you have divergence going on in the market. And when you get divergence, you figure out what to do with it. I don't know what to do with it. In the slow stochastic on the NASDAQ, if we come over here, we had actually this day up both numbers over 80, both over 80. Both over 80 the day before, both over 80 the day before, not the day before that. But I had the 3 days in a row. Got that? Then all of a sudden the market loses that, and today it doesn't gain it back. So what I think happens now is price and the 18-day average likely try to come together. However, again, it's divergence. This is saying that the swing line is up and the bias is up. What I do realize is that the market, if it falls to the 18-day average, that is a support zone, not an area of anything different than that yet. In the Dow Jones, your battleground's the 18-day average of closes. Momentum is flattened out. You still have a trend that is up, higher lows and higher highs, but you're not closing over the 18-day average. Nothing's in sync. In the Russell, today, from the looks of it, I think you're going to lose the embedded reading. It can only be gained back tomorrow, but if it stays lost, I'm going to stick with what I teach. That says that we're game on for price in the 18-day average trying to make a run at each other. So we've got the NASDAQ and the Russell that could be saying more down. The other markets trying to figure out what to do. And as I said, divergence all over the place. In the VIX, you're oversold. You're in an uptrend on the swing line with downside bias. Confusion. In confusion, what often happens is volatility can go away. And what you've done here is you're taking the volatility of the VIX out of the market again. And I'm seeing it because the trade volume is starting to shrink a little bit in these markets too. When we come to TLT, I'm reading arguments which are interesting as can be. Some of the major traders that I follow, and I'm not talking on the floor, I'm talking major market analysts that I love to follow, are saying the market, it doesn't necessarily have to go over that 3% number if we get trade wars, if we have a situation where the market just says, hey, we got up towards 3% this year, maybe we're basing out here. I'm also hearing the opposite arguments of people saying what? They're saying that, nah, the Fed's on for the 3 rate hikes this year, that we're going up, we're going to get over that 3%, we might get up to 3.25%, maybe 3.5% if the Fed follows through. Guess what this market's saying? It is broken out to the upside. It doesn't have an embedded reading, so it is overbought, but it's trying to push out the upper Bollinger Band. Again, I have big divergence. I've got a lower low, a higher high, an overbought market. Now, 2 days in a row over the upper Bollinger Band, which only gives it a 3% chance tomorrow of staying over it if you believe, as I do, that each day that's over it consecutively takes one of those percentage points of that 5% away. It's a rule of thumb. Can you go 7? Often. 9's very rare. But you go and count, you'll see what I'm getting at. When we come to the T-bond market, this is a little straightforward, more straightforward. At least I have an uptrend, higher lows, higher highs. The market looks like it's going to settle just under the upper Bollinger Band, so you're not ahead of yourself. It's trying to push out the upper band, but it is overbought as well. Again, pretty hard argument to be bearish, though. It can say, okay, against Bollinger Bands, I want to come out of a market or to cut my positions down, but that's how I'm reading that one. Same in the 10-year note. Pushing on the upper Bollinger Band, not able to push it out just yet, just like the bonds, overbought in an uptrend with upside bias. Dollar index, confusing as can be. You just seem to be caught in the Bollinger Bands. Look at how they're narrowing in. And if I flip-flop you to the euro, it's the mirror image the other way. It's an inversion. But that's what you're doing here. You're not putting anything together, and I think this is where the confusion is being seen. In the British pound, you're still very much sideways. I will give the pound at least the benefit here of saying higher lows, higher highs, bias up because you're over the 18-day average, momentum sort of waning, but I still don't like the fact that your risk would be from 139.02 under 137.84. It's a pretty big dollar risk on that trade. In the Japanese yen, you tried to rally and failed pretty miserably today. You also took out the high of an outside day down, which often, not always, often results in the market trying to make a thrust for the closest of either a key moving average above the market or the Bollinger Band. Was that it? I don't know. You've still got the lower highs, and I'm going to argue the lower lows. Momentum flattened out here, and the bias is up. I don't know. Bitcoin riding the lower Bollinger Band. Will it embed? The trend is down. It's at a support area that it could easily do better at. It got to 7,700 today. It could be ready to get a bounce off of this, but there's nothing bullish on the chart other than it's oversold. When I come over now to the crude oil versus the Brent, so we're going to have Brent versus WTI. You came from the 3.25 area up to 380, back and forth, and as I've said, this spread was the interesting play up here as it came down to the question is what was going to be the difference where the market found support. It seems to be the 3.25, 350 areas. I'm not as concerned about that now as I am just watching what goes on, and like the other markets that are concerned about world trade, narrow Bollinger Bands, lower highs, but suddenly higher lows, stuck against an 18-day average and flat momentum. Wow. WTI crude. Narrow Bollinger Bands, lower highs. Now let's look at this low right here where I'm pointing, yesterday's low. That number was 60.18. The prior low right here was 59.92. So it pays to always look because visually you can't tell. Higher lows, lower highs against the 18-day average, flat momentum. Gasoline market nullified the bear trend by coming up yesterday through this area, lower highs, lower lows, and then set itself off to the 18-day average, and it sort of stalled out right there. Out of the downtrend, the question is, what does it do next? Natural gas, I've warned that the 100-day average and the Bollinger Band looked like it could be a big resistance zone. Turned out to be that. Still not trending. You got a higher high and a lower low, and a funny time of year. Even if you get cold now, you warm up right away, right? It's already March 15th. People will start looking down the road. I'm going to start getting rid of all the April contracts in a moment and go to the May. So be ready for that over the next day or two that I'll be switching all those charts. Want to remind you, I have a charting course that teaches all this, and it is simple. It's all videos. You see what I do, and then I give you the charting software. You have all the data. You can go back in time, do exactly as I do. Then in the mornings, you see live videos where I reinforce everything you're doing with the daily data. Why not give yourself a try? We're talking, it's not expensive. Most shirts today cost probably more than what I'm doing that for a lot of people. For me, no, but for other people, yes. $130, and I think that's expensive for a shirt, but that's me. 866-973-2077. You can go to our website under the word education. You can come up here and click on it at any point that you want. That link, it'll take you right there as well. If you're watching me on YouTube, it'll take you to that page and explain it all. I'm Ira Epstein. Have a good day. Tired of talking today. Have a good one.